So we went through all that depreciation stuff, talked about the 4 components of depreciation. You've got all that down. Now I'm going to tell you about a couple ways that that companies, businesses can deduct, can kind of circumvent the need for depreciation and write equipment off, certain equipment and assets off immediately. Now, none of these applies to real property, okay? We're only talking about personal property with these exceptions. So real property is always going to be depreciated either over that 27.5 years or the 39 years, okay? But there are a couple of, excuse me, a couple of ways that employers can, I said employers again, businesses can immediately write off some of those assets. Now this first one, the section 179 deduction, expense election, whatever you want to call it, used to be super popular. And it was super popular when the second one that we're going to talk about didn't exist. Because the second one now is actually a better deal. But this 179 is still used by businesses as a way to, again, write off 100% of an asset, or at least up to the 179 maximum. Okay, so can you pull that all the way? All right. Now, in order to qualify for this 179 expense election, the business has to put into service less than a certain amount of assets during the year. And that's the, I'll go through it. So there's a phase out range, but the phase out range doesn't pertain to the income from the business. It pertains to the total amount of assets that are placed in service during the year. So the maximum 179 expense deduction for 2022 is $1,080,000. That means if you have put into service $1,080,000 worth of equipment and you qualify for it, then you can write off, instead of depreciating immediately, or I'm sorry, depreciating over time, those assets, you can write it off in full immediately, okay? Which sounds like a great deal, right? Most people would rather write off, have that tax benefit now than save it for later, but there may be reasons not to do that as well. So in an environment where we think that tax rates are going to increase, then it may make more sense to depreciate an asset over the long term. Because the benefit that you're getting immediately, so for example, if our tax rate, if we're taking $1 million expense, and we're in the 24% tax bracket, that means by writing that off immediately, we're going to get a tax benefit of $240,000, right? Because that's how much tax it's saving us by writing that off immediately. But we are foregoing future write-offs by doing that, right? So if this is 2022, that means in 2023, we have nothing. We have no deduction, unless we added more assets, right? Well, what if the tax rates in 2023 go up to 28%? Or we make more money and it pushes us into the next tax bracket. Well, if we had waited, then we would get a 28% benefit in the next year. So over time, it might be a larger benefit, a larger tax benefit than if we just wrote it off immediately. But in my experience, most companies, well, they don't have a crystal ball. They don't know what's going to happen in the future as far as their income goes. A lot of companies want to go ahead and write that off. Now, also what that means is that if you've written off your $1 million asset, say you got a $1 million asset, you got to write off all of it, the adjusted basis of that asset is going to be 0 now, right? Because it's our adjusted basis, starts with our cost minus any depreciation that we've taken. Now we've got an adjusted basis of 0. If we turn around and sell that asset, now we're gonna have a gain on it. We're gonna have a large gain. Rather than if we had depreciated it over time, then the adjusted basis is going to go down slowly, right? So just kind of one of those, it's, again, in most cases, it's probably going to be more beneficial to take the expense immediately, time value of money being what it is and all of that. And this provides a way for employers to do that. So, but like I said, there's a limit to it. And the limit, again, has nothing to do with the income from the business, but it has to do with the total value of assets that were placed in service during the year. It's phased out dollar for dollar for purchases in excess of $2,700,000. Therefore, it is completely eliminated when asset purchases reach $3,780,000. So that means that if your asset purchases are under $2.7 million, you can take advantage of the full $1,080,000 179 expense deduction. However, if your total purchases start to exceed that, say it's $3 million, now you are $300,000 over that bottom limit. So your 179 expense deduction is going to be reduced by that $300,000. So for example, like I said, so $3 million of assets placed in service. Sorry, I know that's squeaky. How you're going to calculate this is you're going to subtract the $2,700,000. This is our phase out range between $2,700,000 and $3,780,000. We are $300,000 over our lower limit. We're going to take that $300,000. We're going to subtract that from the total that we could take, $1,080,000. So 1,080 minus 300,000. So we have 780,000. This would be our limit, our 179 limit. So that'd be the maximum amount of 179 expense deduction that we could take. Let me do another one here for you. So let's say we placed in service $4 million worth of assets. Well, now we are over the limit. Because if we were to subtract 1,300,000, now we're less than 0. And then we cannot take advantage of that section 179 limit. Let's change it a little bit more. So that's why they say like 3,780,000 is the upper limit. So let's say we're at 3,520,000 total assets that we placed in service. So 20, what is that, 115. So 820,000, we are $820,000 into that phase out range. So now we're going to take the 1,080,000 minus 820,000. These are just not very good. Now this is our 179 limit. So you can think of the range. So it's 2.7 to This is our lower limit, up to $3,780,000. This is our upper limit, so lower of our phase out range. Lower and upper. You'll notice the difference between these two numbers is $1,080,000. So again, these are the assets placed in service. That's the value that we're looking at. What is the value of the total assets placed in service during the year? Okay. Also, there are certain other restrictions here. No, stop. There's certain other restrictions. One is the property must be used in an active trade or business. Property purchased associated with investment or real or rental property is not eligible. So if you have a rental property and you purchase some appliances for that property, then that 179 deduction is not eligible. Okay. Also, if you purchase a building, you can't take the 179 expense deduction on the building, because again, it's only personal property. It also cannot create a net operating loss. What does that mean? So if we have, let's say this is our limit. So we can take $260,000 in section 179, but our net income is $200,000. This cannot bring us below zero. So here we're going to only be able to take $200,000. This cannot bring us below zero. The section 179 expense can't bring us below zero. It can't be the cause that we are of bringing us below zero. If we're already below zero, then we don't get to take the section 179 expense. Okay, so it cannot create, because, and think about that. I mean, if you have a net operating loss, and we are going to talk a little bit more about net operating losses when we get to corporations. If you have a net operating loss, that means it's offsetting other income on your tax return, right? You could really manipulate that income by purchasing assets, right? And again, remember, you don't have to purchase those with cash. You can borrow to purchase them. That means you're not out any cash, but you're getting a tax benefit, right? So it cannot bring us below zero if the total amount of wages, salaries, tips, or other pay earned as an employee is included as income derived from a tax or business. So that means that if we have other income on our tax return, say we're a W-2 employee as well, that gets to be added then to our Schedule C net income. So that gets included. It's just that it's not going to get us below zero on our tax return. Okay, that's section 179. Property cannot be acquired from a related party, or by gift or inheritance. So you got to purchase it, essentially. You could in a exchange, taxable exchange. But if you get it in an exchange, then it's limited to however much cash you paid for the property, whatever cash you laid out for it. So let's look at an example here. ABC Company purchased $1,191,000 of personal property in 2022. The company can elect to expense the full $1,080,000 because they're not over $2.7 million. That remaining $111,000, you don't carry it over. You don't then get to take the 179 expense election next year. You have to depreciate the rest of it. So it's entirely possible that you may have an asset in which part of it you're taking the 179 deduction, and for the rest of it you are depreciating it. And again, software is designed to handle that particular situation. They can pick the assets which they choose to use the 179 expense on, okay? So, this makes sense? The phase out part makes sense? It's dollar for dollar, so it's not a percentage of, well, it is a percentage of it, it's 100%. Dollar for dollar would be. Okay, so that's the section 179 deduction. But you've got all of these, you've also got all of these restrictions on that. So, let's see. Okay. Now, this other bonus depreciation, though, is a better deal for businesses and is used more frequently because it doesn't have this restriction on how much you can take. They call it 100% bonus depreciation. They call it bonus depreciation because it didn't used to be 100%. It used to be, I think it was 50% for a while. I'm not sure if it was ever 25%. I can't remember. But now, right now, it's 100% bonus depreciation, which means you get to write all of it off immediately. It's equal to 100% of the basis of certain property. So again, not all property, not all class lives are included in this. Only certain property. It has to be, it could be new or used. Either one, that's fine. With a maker's recovery period of less than 20 years. So, anything up to 15 years, essentially. So that's personal property. Again, that 20-year property is going to be mostly agricultural buildings, so that's kind of that's a real estate. Also, the property acquired and placed in service has to be placed in service prior to December 31st, 2023. This is the last, unless Congress changes the law, this is the last year that this bonus depreciation is going to be 100%. What's going to happen with it is it's going to be phased out until it's eliminated as of 2027. That's a sunset clause. I don't know if you've heard of sunset clauses when they make tax law. In order for tax law to fit the budget that they need, so they want to give tax cuts, but they also have budget restrictions. They've got to keep the price tag of those tax laws under a certain amount. Oftentimes what they'll do is they'll pass a law, but then they will phase it out. So you get the benefit now, and they get the political benefit of it now, but then at some point in the future it's going to go away. Because in order to make the finances work with the budget, and like that stops them from spending money, but in order to make it work with the budget, they've got to add these sunset clauses. That's what this is. So this bonus depreciation, unless they pass a law extending this will slowly be phased out over 5 years. I don't know what the phase out is, like if it's going down to 80% and then 60, and then it might be, I don't know off the top of my head. But eventually it will go back to 0, which means more tax revenue, right? Because now people can't write off 100% of their assets. It also means probably that businesses may cut down on the amount of purchases of assets because they're not going to get a tax benefit from it. Okay? So, Jack purchased a piece of new equipment for $570,000 on March 1st. He gets to write off all $570,000 of it using his bonus depreciation, 100% bonus depreciation. Doesn't matter how much he spent on other assets. And you can use both the 179 and bonus depreciation on different assets during the same year if you want to do that. That 179 deduction though, if this is allowed to phase out, that 179 deduction will come back into play more, will be more prominent again. So, like I said, before they had the bonus depreciation, 179 was where it was at, but this sort of eliminated a lot of that. Okay, so those are a couple of ways that businesses can write off 100%. Like like I said, there's benefits and detriments to both. And that's where tax planning comes in as well. Questions? No? All right. Simple enough, right? 100% bonus is pretty easy. I mean, that's just 100%, right? 179, you've got that phase out. Okay, so we have this category of personal property that they call listed property. Listed property is property that could be used personally, or that is commonly used personally and for business purposes. So for example, an automobile. Oftentimes, especially small businesses, they'll have an automobile that is used both, you go run your errands with it, but then you also use it for your business. So it could be used for either. It used to include, listed property used to include computers, but it doesn't anymore. Now, for the most part, it's any passenger automobile, any property used as a means of transportation. So, like a tractor wouldn't be included in that. That's a vehicle, but it's not used for transportation. Except this time of year when you're down to 20 miles an hour on the highway because you're behind the farm equipment. But it's not used for a means of transportation. Also, any property that is generally used for entertainment, recreation, or amusement, like a boat. This would include photographic, phonographic, communication, and video recording equipment as well. So if you have like a camera or something that you're using both personally and for business purposes, that would be considered listed property. So what does it matter, right? There are some special rules with regard to listed property, and of course there are rules that then limit deductions that people can take, because it can be, they don't want individuals just getting a deduction for their personal property, right? So that's what these rules are designed to avoid. So the regular maker's rules do apply as long as the property is used primarily for business. Well, not primarily, predominantly for business. Their wording is better here. That means more than 50%, okay, or 50% or more. So predominantly for business, or actually it is more than 50%. So anything more than 50% used for business, then you can just use your regular maker's depreciation. There's nothing special about it. I mean, you're only going to get to depreciate the half of it that's used for business. So for example, if you buy a computer, well, I won't use a computer. We'll use an automobile. And you spent $26,000 on it, and you use it 75% for business, then you get to take 75%, let's make this 20, because 75 is easier to calculate. Then you get to take $15,000 is your depreciable basis. The other $5,000 is personal use, so you don't get to depreciate that part. But that $15,000, then you could take $179 on it, as long as you didn't place in service more than $2.7 million of other assets, then that would be reduced. You could take bonus depreciation on it, but you can only take the portion that is business, right? Because this is biz. Okay. If, however, or you could depreciate it using those tables that we looked at, okay? If, however, at any time that business use falls below 50%, then you can no longer use the accelerated depreciation that is shown in makers. You have to use straight line depreciation, okay? So you have to keep track of how much you use it. You know, whether it's, and that's why it's important to kind of keep that business usage over 50%. So, well, this is a bad example, because they go through all of it and then they say, oh, none of it's deductible. But if this was a business asset, so Linda's phone, her cell phone use is 70%. So remember that, so that's listed property here, because it's communication equipment, right? So the cell phone would be included in that. Her phone use is 70%, so in that case, she could depreciate it, she could take the, there's no special treatment to it. If it doesn't meet that predominantly business use test, taxpayer cannot claim 179 expense deduction, so you would no longer be able to claim that 179 expense deduction, and you have to use straight line depreciation. And it's a 5-year recovery period. So here, we've got Jack purchased a large screen for video conferences for $2,500 for use in his home office because he's self-employed. The screen is used 70% for business and 30% by his children to play computer games. Because the screen is predominantly used for business and is 5-year property, the maker's depreciation for the first year would be $350. So $2,500, 70% business use, and then if we look at that table, for the first year, it's 20%. If the business use were only 30%, he'd still get depreciation on it, but he would have to depreciate it over the 5 years, and he would get $75 of depreciation deduction on the, so it would be straight line. This is the first year, when did he buy it? I'm trying to think why they used, where the 10% is coming from. 10%. Where's the 10% coming from? Large screen. Alright. I don't know where the 10% is coming from there. I have to look that up. Because that would be, because for straight line, if it's still 5-year property, that would be 20% over the first year. Anyway, I need to look at that one a little bit more closely. But that's the difference is, you have to use straight line depreciation, it has to be over 5 years. If it's under 50% usage, and you can't use the 179 deduction. Yeah, you think, okay.
It says the 10% is calculated by taking the straight line rate of 20% and applying the half-year convention.
There we go. In its first year, right? Okay. Thank you. So, so that's the half-year convention. All right. So if the 50% test is met the first year, but then that usage falls below 50%, what you have to do is recalculate the depreciation. So you've got to calculate it based on the straight line method, and then you have to recapture any additional depreciation that you got to begin with because of that accelerated depreciation. Okay, so that's a depreciation recapture. So, and this is an example of what that would look like. So you just kind of compare, okay, what would it be under makers? What would it be under straight line? What would it have been that first year? Now he's got to recapture the $175 of depreciation. Essentially what happens is that now becomes income. So he's going to be taxed on that $175 because he got a tax benefit from it that he shouldn't have gotten in the first place in the previous year. Okay, that recapture part is going to come back to us when we start talking about chapter 7 as well. Okay, so that's listed property. Again, it's only certain types of property that mainly could be used personal use and business use. If it falls under 50% business use, then only straight line depreciation, and you cannot use 179 deduction on it. Were you gonna ask?
Yeah, so like somebody who's self-employed who, I'll just use my roommate as an example.
Mm-hmm.
He works for a company that does interior and exterior inspections for insurance companies.
Mm-hmm.
And he uses his vehicle, I would probably say 80% of the time
Mm-hmm.
to get back and forth between his claims and things like that.
Mm-hmm.
So he could depreciate the value of his truck.
Mm-hmm. He could, or, and you'll see when we talk about travel and transportation, the other option is that he can get a deduction on a per mileage basis.
Yeah, per mileage is like, sucks, doesn't it?
Not anymore, it doesn't, it's about 65 cents a mile, something like that, which, I mean, 1,000 miles is $650
Right.
for the deduction. So, there are a couple of different options that you have, but yes, he could depreciate that 85% of the vehicle.
Okay, so he could choose to depreciate 85% of the vehicle or do the per mileage because like they travel across states. Like he was just in California
Yeah.
and he drove out there and then he
Right.
drove all the way back. And
Yep.
so, okay.
Yep.
Okay.
Yep.
What
So-
does that mean?
Oh,
Sorry. Go ahead.
yeah, Andy, I want to tell Andy, I want to make sure for something. We want to know if 100%, 75%.
So
Table.
I mean, some of it's gonna be estimation, right? Like if it's a vehicle, what you should do is keep track of the mileage. So you keep track of, so I drove my car a total of 20,000 miles this year, 15,722 were for business, and I've got a log of all of it, with each business trip
For this
delineated.
case- for this
Cell
case-
phones are a little bit, it's a little bit trickier. I mean, if you wanted to get really particular about it, you could get your log of your cell phone usage. Yeah, and I mean, internet as well. A lot of it is estimation. Chances are with something small like a cell phone, or I don't know. I don't even know if an iPad would be included because that's sort of a computer, but it's sort of a communication device as well. But anyway, it's kind of hard. Those are small amounts too, so but anything that you can use to substantiate it. Vehicles are easiest because you've got that mileage. Yeah.
To piggyback off of her situation, what does that mean for the employer?
For the employer,
Yeah, like if he's deducting his mileage for his job, does that affect the employer at all?
so and we're talking about self-employed people
Okay.
here, so the taxpayer is the employer.
Right, but I was talking more along the lines of her situation.
Well, if her, but she,
He's a 1099.
he's a 1099, so
Yeah.
he's a contractor.
Okay.
For employees, though,
No.
there is no deduction.
Yeah.
That's why you wanna get your employer to reimburse you
Okay.
for those kinds of expenses. Because as long as the employer has an accountable plan in place, which is super easy to do, I was just talking about this in the payroll accounting class, and I probably talked about it with you guys too when you took payroll accounting. As long as an employer has an accountable plan in place, then all of that reimbursement, the employer gets to deduct it as an expense. The W-2 employee, it's not taxable income to them,
Okay.
so.
Okay.
And yeah, I mean, with gas prices the way they are and the reimbursement rate these days, it used to be really bad. For charity, medical, what's the other one? Moving expenses, it's not that great. But for business, it is a pretty good rate.
Is there a limit
A
on the
limit to the,
mileage?
no,
on the deduction?
no.
There
You
isn't?
just have to be able to substantiate it,
Right.
yeah. As long as you can substantiate it, there's no upper limit to how much that deduction can be.
Okay.
Okay, another limitation though that we do have is this concept called luxury automobile limitations. Now, you look at the amounts here, and I don't think anybody would argue that these amounts would be for a luxury vehicle. But essentially what it is, it's a limit on vehicles, how much depreciation you can take in a year. So the IRS, again, there can be a lot of fraud along with automobiles. People will buy expensive automobiles and say that it's used for business and then get a write-off for this expensive. So what this does is it limits how much can be taken in each year for an automobile. Now, it has to be a passenger automobile, which is defined as a four-wheeled vehicle made primarily for use on public streets, roads, and highways, and it has to have a gross vehicle weight of less than 6,000 pounds. Okay? So the limits in year one, it would be limited to 19,200. So you would calculate, and this would include the 179. So if you're gonna take the 179, you'd still be limited to that. It includes the 100% bonus on that particular asset and regular maker's depreciation. So even if you had, so if you bought a car for $50,000, in the first year, even if you took the 179 or the bonus, you'd be limited to 19,200. Okay, and again, that's to keep people from buying really expensive cars, more expensive cars than what they actually need for their business, and then writing them off, right? Again, and if the business use is less than 100%, then you have to take whatever portion of that. Yeah, you look like you're gonna raise your hand.
Yeah, so what about, so this is just for like luxury vehicles, like a Range Rover or,
This is for any vehicle, passenger vehicle, four-wheeled, primarily for use on public streets, roads, and highways with a weight of less than 6,000 pounds.
okay.
Don't be misled by the word luxury.
Well, I was
It's-
just, we were talking about it and
Yeah.
the first thing that popped into my head was like semis. Cause I know guys spend,
That's-
$75,000
Right,
on a semi.
that's not a passenger vehicle.
Got it.
And that's way more than 6,000
Yeah.
pounds. So it would not be limited to, it wouldn't have these limits. Now, what used to happen, I don't know if it's still happening or not, people would buy Hummers because they're more than 6,000 pounds, so technically they weren't included in this limitation, and they would write it off. So here we've got Allison purchased a Toyota Camry for $25,000 to be used exclusively for business, so 100% for business. 100% bonus depreciation deduction would produce a deduction equal to $25,000, but because the most she can take on that vehicle is $19,200, that's what she's gonna be limited to, right? She could still use maker's depreciation, that's gonna get her a deduction that's less than this amount, obviously, because it's gonna be over 5 years. But the additional amount, $5,800 will be carried forward. That will be depreciated over the regular maker's life of the vehicle. But this is the maximum amount. Here we've got Jackson purchased a new car for $20,000 on July 7th, 2022. He used it 75% for business. So this is, I don't know, this is wrong, 18,200, why are they using the, I think it's supposed to be 19,200. I think they made a mistake here in this example. But the point is, Jackson would still be limited to 75% of that, but I know why. Because this amount, although that's not the right amount, that should be 19,200, is limited to 75% of it. So this limit is also gonna be limited by the business use percentage. So for example, your roommate, if he would be, if he bought it this year, he'd be limited to 19,200, but we'd have to multiply that by 85% because that's the usage, and that would be his limit.
Okay, so what if he bought it prior to starting where he's at?
So then we're talking about converting it to personal, we're talking about converting a personal use vehicle
to a business.
to a
vehicle.
business use, so his basis is going to be, remember, it's gonna be the lesser of the cost, or what is it, the fair market value minus the adjusted
The adjusted
basis. So,
okay.
yeah, so he's gonna be starting from a different point
Mhm.
than what he actually paid for it.
Got it. But if you bought like a new truck,
Yes.
that's where that would
Yes.
start. Got it.
Yep, and then these are the limits for each succeeding year, so this amount goes down, this limit goes down, so if you're in the second year and it's a luxury auto, you're gonna be limited to 18,000.
Got
Okay. This is just talking about the SUV limit. Let's see. Okay, what is this? Now, the one, I think back, see, this is where I'm confused a little bit. Because they say up here, limits apply to the 100% bonus. See, I didn't think they did, but they say, and I'm thinking that's, I need to look at that too. Cause here we got Javier purchased a new Yukon for 46,000, although the Yukon might be more than 6,000 pounds. 100% for business, he could deduct a maximum of 1,000 in 179 expense. And 3,800 in makers. Or with a 100% bonus, he could deduct the entire 46,000. I'm thinking the Yukon's over 6,000 pounds.
Yeah.
Is why that is, yeah. Although they don't really say that. Those are big. Alright. Leased vehicles have some special rules. You still get a deduction for it. There are tables that the IRS puts together to indicate it has to do with the year that you started the lease, and the lease, so it's the year you started it, and then the lease payment, and then you look at this table, and it tells you essentially what your deduction is for that lease. It's based on the fair market value and the tax year in which the lease began. If the business uses 100%, you can deduct the full lease payment. All of this has to be kept, the records have to be really good. Like, this is a highly audited area, because oftentimes taxpayers will put together their logs at the end of the year, which you're not supposed to do. Even if it's accurate, that is not adequate substantiation. You have to keep it contemporaneously, meaning at the time that you use the vehicle, you've got to keep that log. I would always tell clients, they would do it on Excel spreadsheets, which is fine, or keep you go to Best Buy or Staples or someplace, they have these little mileage logs that you can keep. Yeah.
The Yukon max weight is 5827. So
5827.
yeah.
Okay.
So could we do that problem based on
So the
what it would actually be, since that's incorrect?
Yeah. So this one, well, it's going to be, if it was placed in service May 3rd, 2022, then we're going to still be limited to the 19.
Got it.
Yeah, to the 19.2 for this year. All right. Any other questions?